Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, September the 18th, 2025, recording this in the morning. All right, let's have a quick look and just review the Fed. I think probably a lot of people you've probably already looked at this, but let's just have a look. Kind of interesting just to see there was a sort of a tale of two different price reactions, and immediately at 2 o'clock yesterday we had the press release, which I interpreted as being relatively dovish, and I think the market did as well. Obviously, the dots was relatively dovish. A couple of the things here is that they said that inflation has moved up and remains somewhat elevated. We'll get back to that in a second. What I thought was interesting, the committee is attentive to risks to both sides of its dual mandate, but this was new and judges the downside risks to employment have risen. So really it's saying that they have the twin mandate, but that they are more concerned, a little bit the weighting is more concerned about the employment. So that's sort of dovish, and that's indicating that they don't mind a little bit of inflation. They don't mind if the economy is sort of running hot. They're really going to be very, very focused on the employment situation. And of course, immediately this morning at 8:30, we do have the latest numbers from the initial jobless claims and the continuing claims. So that seems to be the main issue. They didn't really they didn't stop their reducing their holdings of treasury security, so they're continuing to do quantitative tightening. There could be, like, later in the year, maybe the October or December meetings, be some talk about that. So at this point they're still kind of tightening. The other interesting thing to note from the statement was the voting pattern. Clearly, Stephen Miran voted against it. He wanted a 50 basis point cut. But what was kind of interesting from a political positioning point of view was that everyone kind of coalesced around Powell, and there were no dissenters. So nobody voted for a hold. There was only one voter for a 50 basis point cut. And so it was interesting that people like Waller and Bowman, who had been on record of being fairly dovish and potentially in line for the Fed chair job and wanting to cozy up to Trump, they didn't vote with Mirren, and they actually voted with the chairman, with Powell. So that was, I think, almost kind of a political statement saying, hey, the Fed is still coalescing around the chair. It is unanimous. But this does raise a few problems, because if you have we had an 11-to-1 vote, so an 11-to-1 vote. But let's now look at the dot plot and the summary of economic projections and just see what's going on there. And the first thing to jump out was that the median dot of where the Fed funds futures should be, according to the Fed members, is at 3.6% rounded by the end of this year. And of course, that would be three cuts. That would be three cuts, which is a little bit more than what the market was pricing in. So that was initially a very dovish read. You see, it went from 3.9 last time to 3.6. But then it gets a little bit interesting, because the FOMC actually revised upwards the change in the GDP. So they're basically saying the economy, they thought, might actually be a little stronger, the growth, than they previously had expected. So revised from 1.4 up to 1.6. And then if you go out to 26 and 27, that's just sort of slowly rising. If we look at the unemployment rate, unchanged, and then actually slowly coming down to reasonable levels, in the next couple of years. If we look at the core inflation, unchanged, but still at 3.1%. So keep in mind, this is a Federal Reserve, which in theory has an inflation target of 2%. Now, they sort of tried to fudge the numbers a little bit by saying, oh, in 2028, in the long term, that will get down there at some point. And it's going to gradually go down over the next few years. So I think that's a little bit of, sort of political sort of horse trading there to sort of fake those numbers a little bit. But the point is that they're saying that over the next, sort of 15 months or so, they are still expecting core inflation to be well above their target. I think that's a tacit admission that they're not really super focused on getting it down to 2%. Otherwise, they probably would have hiked. So that's kind of interesting. But what's interesting there is that in this situation where you have core inflation projected to be 3.1, 2.7, whatever, over the next sort of 6 to 8 months, you have a GDP which is actually growing according to the last forecast, and you have an unemployment rate which was unchanged and actually revised slightly downwards. how could it be that they're cutting interest rates? It just seems a little bit counterintuitive. So at this point, you have to say possibly this is some kind of political thing, and we'll get onto it because Powell in the press conference did, have a slightly different tack. It's also kind of interesting to look at the dots themselves. Look at this crazy dispersion. Now we have this dot down here. Keep in mind the Fed funds futures rate yesterday was 4.33. So basically at this midpoint, we're up a bit here. So one person still put a dot of saying no change, no cuts at all. So one person there, I wonder who this hawk is, and yet nobody voted against. That person didn't vote against the cut. So you see this, we're starting to get these internal inconsistencies that one person said that there shouldn't be any cuts at all this year, and yet that person voted for a cut. So there's already, and some people saying that in terms of credibility, you have to say this is a bit strange. Like if you look at the last BOE meeting before this morning we had a 7-2 vote on the Monetary Policy Committee. But if you look at last time, we had a 4, 4, and 1. So we had four people, and one people. So there really was a dispersion of sort of thoughts. And one of the interesting things about Trump and Miran is that Miran especially has campaigned against what he calls groupthink. Basically this idea at the Fed that, Jerome Powell calls everyone the Thursday and Friday before the meeting and basically corrals them into doing what he wants to do. And essentially, it's all about the chairperson. And what Trump and Miran are saying is that there's groupthink, there needs to be more diversity of viewpoints. Well, maybe not Trump is saying that, but Miran is saying that. And, at a certain point, my personal view is that if the Fed does want to retain credibility, if someone is going to put on their dot no cuts at all for 2025, and then, half an hour later vote for a cut, that puts into the validity of the dot plot as a kind of complete waste of time, or a lot of sort of cynicism, or let's just call it cynicism or hypocrisy, because you also see that there's one person's actually about 6 people saying only one cut. So all I'm trying to say, there's a lot of dispersion here, and yet the vote was essentially unanimous, 11-1, apart from Miran, who obviously is Trump's puppet. And I think the Fed really needs to look at that and just be a bit more comfortable about sort of having wider views expressed in the public. Anyway, enough of that. But the point I'm trying to make here as well, just from a market perspective, is that there was quite a lot of dispersion in the dots, although the median was for 3 cuts. Okay, so let's now look at the market reaction. And it's kind of interesting here just to see, because there was clearly a 2-part market reaction here. And what I want to start with is just, let's say, for example, looking at the ES, like the stock. So I've got here a 5-minute chart. And really what you can see is like a huge amount of volatility around the decision itself. And then the market has essentially voted, after about sort of 3 o'clock, 3:15, when Chair Powell stopped speaking, the market has essentially, I think, come to the conclusion that, they're saying, what are they saying? The economy is relatively robust. Inflation, they're prepared to live with slightly stickier inflation. They will be cutting once or probably twice, maybe not 3 times. That they do believe GDP is going to be growing, and their focus is on employment. So any sort of weakening in the employment, they'll definitely probably cut in a slightly more aggressive way. So if that's the situation, you have a Fed which is cutting, once or twice this year, and potentially 2, 3, 4 times next year, in an economy which the Fed themselves believes is robust and is certainly not falling off a cliff. So if we just look at some of the market reactions here, we see on the 5-minute chart, we see the ES mini futures. Initially, they popped up just on the fact that 3 cuts were priced into the put on the dot plot. But then we'll go into the press conference, and you see there was a lot of volatility there going up and down. We also can have a look at NASDAQ. You see similar kind of situation up at new highs there. We look at the Russell, not actually achieving new highs. So the Russell sort of underperforming a little bit, still relatively possible, but the Russell not enjoying the benefits of that as much. Then if we look at just look at some basic markets here, let's say, for example, the 10-year bond. Actually, we'll look at the 2-year because that's important as well. So you see the 2-year immediately went up about 7 or 8 basis points, priced in about extra cuts of about 7 or 8 basis points here. But once Powell started sort of talking in the press conference, immediately reversed. So essentially we're back down to price level 1. No real change. If we look at, let's say, the longer term bonds, the ZB, a little bit more negative here. You see that's actually gone below where the meeting started, and you can see that we're trading below that. So there's a sense there that this is a less a sort of aggressive Federal Reserve in terms of combating inflation, and that's not great for the long end of the bonds. Also, this is an economy which apparently is going to be allowed to run a little bit hot, and we also have sticky inflation. So the point here is that the Fed. Oh, the other issue as well is that the Fed is still doing quantitative tightening, as we just saw in the statement. They didn't indicate at all that they're getting any closer to sort of reducing their quantitative tightening. So they're still sort of selling bonds or into the market, so to speak. Or not selling bonds, they're not rebuying bonds as they roll off. And so therefore, all of that stuff is a little bit negative for the long end of the curve. So we had a little bit of steepening there. So the bond's not loving it. If we look at a couple of other markets here, just want to look at basically the dollar indexes. Look at the dollar index. Again, you see this early sell-off down here based on the fact that the Fed, on the dot plot said they were going to cut 3 times. But again, the press conference, we see that the dollar has actually, as we're trading here at about, 7:45 in the morning here, the dollar is actually up. So overall, sort of the takeaways are, Fed's going to be cutting. They've bent the knee a little bit to Trump. They're going to start cutting a little bit in some shape or form, not massively, but that's okay because the economy is quite strong. And if the economy does weaken, or especially the labor market does weaken, they will cut more aggressively. So this is quite a nice sort of mix for especially something like the stock market. Is feel free to rally here. And if you can just have another quick look, well, let's say look at something like gold as another market. Again, you see it initially popped on the 3 cuts being priced, and then as sort of flattened off a little bit. So what was it in the press conference which sort of got the market's attention? And pretty simply, the Powell gave a bit more of a complicated sort of diagnosis of the situation. I've just got some notes here. At 2:41, so about 10 minutes into his press conference, Powell said, and quote, there wasn't widespread support for a 50 basis point cut today. So essentially, early on in the press conference, he said, guys, the 50 basis point was not really a big thing. So that's a little bit more on the hawkish side, which is positive for the US dollar. Of course, less good for gold, less good for the bonds. And then he said, then a minute later at 2:42, he said, quote, you can think of today's move as a risk management cut. So a risk management cut. So essentially, what is that saying, a risk management cut? They're not really saying, oh, we're seeing horrible data, we need to cut in an aggressive way. They're saying that there are certain complex signs out there. It's difficult to know exactly what's going on. We want to preempt any potential weakening in the labor market or the overall economy. So it's a risk management cut. So again, this idea that the Fed is cutting because they're behind the curve and that the economy is falling off a cliff. The Powell's not saying that. He said it's a risk management. They're sort of saying, well, things are not too bad, but we don't want to take too many risks. And that's why I think the equities are quite enjoying it. And obviously, you could argue that's slightly less dovish than the dot plot, which of course is saying 3 cuts this year. And that begs the question about some of these contradictions I was talking about. If Powell's saying it's a risk management cut, and yet at the same point he's saying it's data dependent. So if it's data dependent and there's no obvious signs of weakening, why are they cutting? So what I'm trying to say is there's an internal contradiction between a logical contradiction between saying you're risk managing things and data dependent. Although there are signs, one could then of course go into the weeds and say there are certain indicators that the data is weakening. It's complicated. But anyway, so let's then keep on going. He then at 2:50, he said the Fed is in a meeting by meeting situation. So again, he was not saying to market participants that there's a very clean kind of glide path or forward path for just very smooth interest rate cuts. And meeting by meeting is essentially saying, well, we're not necessarily going to get another 2 cuts this year or even 1 cut this year. And Powell continues to poo-poo the validity of the dot plot and clearly is not a fan of the dot plot. So the fact that the dots were saying 3 cuts, Powell here is directly contradicting that, 20 minutes later, actually 50 minutes later, and saying that it's a meeting by meeting situation. And then finally, 2:52 p.m. says the situation of two-sided risk means no risk-free path. So again, this idea that there are two-sided risks. He also, during the press conference, was very keen to say that there was some downside risks in terms of the employment situation worsening, the real economy weakening. But he also signaled the fact that there was upside risks and that tariffs and inflation wasn't defeated, and it still could sort of rear its head a little bit and increase a little bit there. So just by flagging the two-sided risks, that's also a little bit more sort of hawkish. So. So there we go. That's it for the Fed. So what happens now? Let's just go back to the daily charts. So at this point, if we go back to the stocks, let's just go back to the ES up here. We essentially have a situation where you can see the ES pushing higher into new higher territory. We look at the Nasdaq also pushing up. This looks as though it's going higher, and that's on as I said, a fairly benign environment, at least from monetary policy situation of the Fed, which is saying, hey, we're going to cut, in some shape or form. We cut once, we might cut twice or thrice this time. If everything worsens, we'll cut quite a lot. If not, we'll still cut a little bit. The data seems okay, and if the data weakens, we've got your back basically. So that's a fairly positive tailwind for the equities, and I expect the equities to continue rising, quite frankly. And that also could be the dollar. Everyone's very short. The dollar positioning is quite stretched in the dollar. It's going to be interesting to look at the dollar index here, the Dixie, and against things like the euro, and just see if there is any sort of structural strength still here. You see there's not a huge amount of follow through. So one of the problems with the dollar is this idea of less Fed independence, plenty of, there's still sort of a bit of sticky inflation. There are sort of structural reasons for dollar weakness here. So I think it's going to be very interesting over the next, let's say, 1, 2, 3 trading sessions to see if the dollar gets any purchase, if it gets any grip here. And can push higher. But so far it looks a little bit weak. And so it's looking as though the stocks are going to enjoy this, but the dollar is going to struggle to push too much higher. So we'll keep an eye on things, obviously, like the Japanese yen. You see here the dollar pushing up against the yen. But against the euro, for example, well, not too bad. But, again, not really like a strong move. Okay, so I also just want to look at the shape of the curve. Let's just bring up the 230s. And we can see here that overall pretty flat, not a huge reaction here because yes, the Fed did cut, so that's going to bring down the front end rates. But as we saw when we looked at the ZB, so the 30-year bond, there's still some concern that the economy, concern from the long bond market, that the Fed is still doing QT, the economy is still relatively strong, inflation is still relatively sticky, and that the Fed is less aggressive potentially in combating inflation. And all of that is a recipe for long end bonds not to fall, but actually to remain stable or perhaps even rise a little bit. So it wouldn't surprise you if we start to get a little bit of gentle steepening as we go forward here. And as you can see, technically, this is quite an interesting level here. For those of you who want to play that steepener, that's quite a nice level. What we also got, so enough for the Fed. Let's see, as I say, we also have today initial jobless claims. Now, you remember last time they came in about 260,000. Let me just, actually, we'll just quickly have a look at the Fed probabilities now. So you can see here that for the October cut, the market is still expecting almost a full cut here, 22 basis points. So that's almost like a 90% chance of a cut in October. And by December meeting, we've got 1.8. So, 45, so not quite 2 cuts here. So let's keep an eye on these as we go forward. And also, obviously, this morning we're immediately going to get a new read on the labor market in the U.S. Have initial jobless claims. Remember last week it came in at 263,000, and that caused the bond market to rip higher, the dollar to come off. Quite a big reaction. Subsequent to that, a lot of sort of economists and analysts have actually crunched the numbers. And it seems that in Texas, there was a particular spike, maybe some kind of fraudulent claims, and that this number was, perhaps going to be revised. So let's keep it, first of all, revised down, that is. So let's keep an eye out for revisions. And also let's basically see what's expected this week, 240,000. The market's going to be quite interested to see, A, whether the prior week's numbers are revised downwards, or B, just if this sort of idea that the initial jobless claims are starting to head upwards, because that would get the Fed's attention and the market's attention. So let's look at these numbers this morning. We have initial jobless claims, the 4-week moving average. That's pretty important. That's sort of heading up a little bit. And probably also very important is the continuing claims, because what Powell said yesterday is this idea that there's less labor supply coming in, but maybe less people being hired. So we're in this sort of stasis, in this static position that obviously there's less sort of undocumented workers, undocumented immigrants coming into the US since Trump took power. And that means that there's less and less sort of cheap workers coming in, but you know, the people are not really being hired, but they're not really being fired. So the market's kind of sort of flat at this point. And so we want to see the continuing claims, because something which Powell was saying yesterday is that it does seem to be harder to find a job if you're fired, and that it's taking longer for people to, you know, find new employment, and therefore the continuing claims, which is, you know, ongoing claims, is slowly rising. So let's keep a look at all those numbers this morning. That's going to be important. Let's just see a couple of headlines coming through. Hassent, economic advisor. Looks like Fed decision was data dependent. Data dependent decisions when the Fed is at its best. Mirren's analysis, heartfelt. Oh, heartfelt, that's an interesting word. No partisan influence. Okay, all right. So nothing too much there. Just a couple of things. Yesterday we got the Bank of Canada. They cut quite. I mean, a lot of that was missed in the whole sort of Fed thing. But if we just look at USD CAD here, just for example, so basically Macklem, the governor, of course, of the Bank of Canada, was essentially pretty similar to, well, actually a bit more negative than the Fed, in two words, essentially saying that inflation was still a little higher than they wanted, still a little bit sticky, and they had to be prudent and careful about that. But definitely, this is the USD CAD chart here, but also Macklin was really saying that there are signs that the Canadian economy is weakening in a, you know, quite significant way, and that they needed to cut in order to just a bit of a preemptive sort of boost to the economy. And so the thing is here that it looks as though the Canadian dollar is relatively weak. Now, again, not necessarily against the US dollar, which we know itself is under quite a lot of pressure here, but maybe against the cross pairs in combination with a Bank of Canada, which, you know, quite possibly could be cutting another once or twice this year, especially as the Fed is cutting, and also weakening real economy. Wouldn't surprise me to see the Canadian dollar weakened, but maybe against some of the cross pairs. And you can see, for example, here's Euro CAD. You see the euro pushing higher against CAD. If we look at, let's look at a couple of pairs just to have a situation here. You look at the Australian dollar versus CAD, you know, in general, it came off the last couple of days, but in general has been quite strong. If we look at CAD, JPY, well, last 24 hours actually a bit stronger, but overall, you know, kind of in a holding pattern. So that's an interesting one. Keep looking at CAD. Also this morning, just for the record, we just had the Bank of England. They voted for a hold, so no cut. That was expected. And we're just looking at comments here from Bailey that they're still quite worried about inflation. And the vote this morning was 7-2. So only two people dissenting, seven people on the Monetary Policy Committee over in London voting for a hold. And you see here, the pound's been quite strong against the dollar, but now coming up against our sort of recent highs. So maybe just taking a little bit of a pause. Let's just have a quick look before we finish here on the headlines, just from the Bank of England. Just want to sort of keep up on that. What's going on? Latest headlines. Right. So Intel jumped 17% after NVIDIA agrees to buy a nice stake. Okay, so we know that Intel now is partly owned by the US government. NVIDIA is having problems with their chips being banned temporarily by the Chinese authorities. Okay, so this is obviously good for Intel. That's interesting. So the BOE's Bailey rate cuts need to be made gradually and carefully. So again, a fairly prudent. So we're getting a little bit of monetary policy divergence. For example, we see the BOE here, you know, prudent, gradual rate cuts, whereas in Canada, it looks as though they need to be cutting in a more aggressive way. And we just spoke about the Fed. So Bailey in no rush here to be cutting rates. BOE to sell fewer long gilts than other maturities. Okay, so that means supporting the long end of the curve. That's maybe just trying to keep the long end of the curve anchored over there. Let's have a look here. Slowing the pace of quantitative tightening. Okay, won't go on too much more with that. All right, I'll leave it there, guys. Have a great day. We'll continue this tomorrow. So in the meantime, let's just see if we get any Fed speak today. No doubt Trump will be out sort of blasting Powell for being too little and too late and too moronic and all those things he likes to say. Poor old Powell. I think he needs a holiday at this point. In Jamaica or the Bahamas or something. But anyway, and also let's keep a lookout for continuing claims and initial jobless claims. Thanks very much, and we'll see you tomorrow. Thank you.